So the photo that you're seeing in front of you is a photo of the New York Stock Exchange, and Mr. Liddell will be going into that experience later on in today's webinar. We ask that if you have any questions throughout the session, you please type them into the chat and I will read them off as we go. Tonight, we have a special guest, Mildred Gaddis of The Mildred Gaddis Show, hosted on 105.9 FM on Sundays at 8 a.m. And I'll let her kick it off.
Thank you so much. I was thinking about this evening's meeting and thinking about just how much has happened in the world. And I think we've all been concerned about not only what's happening on a national level, and around the world, but also what's happening for us here in Michigan and for people who are joining us from other places. You know, when we think back during the 20th century, for the last half of that century, it was the real estate industry that carried the U.S. the housing industry, which carried the U.S. Economy. And here we are in this 21st century, this 21st century world. A lot of us are asking the question, how do I get to where I need to be? There's been a lot of talk, of course, led by ELE Wealth Management, about building community wealth, and perhaps more importantly, about legacy wealth business. And so the question becomes, how do we do that? For Black America in our communities, historically, our wealth has been built through real estate. I mean, it was the gold. But now we're finding that there has to be, or we need to explore or grab hold to some of those other alternatives. And the one that's up front and center right now is about stocks. What are stocks? For a long time, a lot of us thought that it was just a bunch of rich guys gambling and getting wealthier. Only to find out that was not the case. How do we access this thing? For a lot of us is foreign soil. We're totally unfamiliar with it. Mr. Ellis Liddell has been talking about stocks and bonds and all of this in this particular time. Well, before now, to be factually correct, over 25 years. So the question now becomes, since it is a viable alternative for those who understand it and those who are in a place and time when they can benefit from it. So tonight he's going to walk us through this particular industry and these disciplines so that we can better understand them and certainly win in this game that we call capitalism and building wealth. Mr. Ellis Liddell.
Well, thank you, Ms. Gaddis, and thanks for that powerful, purposeful pause in the beginning of the show. It's always a purpose. So, Ellis, if you'd be so kind as to put back up the New York Stock Exchange picture for a minute, I'm going to talk and then we'll take it back down. But I just want to make sure that everyone understands that what you're looking at there, the New York Stock Exchange, is where wealth is made and created. There was like less than 30 guys got together in New York City under a tree, and they decided there ought to be a way to raise capital in America. And it was the first country to do it. And these guys said, if we could figure out how to raise money for other businesses, we can help grow everybody's wealth. And that's how it all began. So the New York Stock Exchange today sits where that tree used to be, and those guys were who came up with the concept of raising capital. To this day, raising capital has created trillions upon trillions of dollars of wealth around the world for everybody to participate in. And it has created billionaires all over the place. And these billionaires have funded many projects. And when you have one billionaire in a community, and Detroit boasts many billionaires, and I can just name Gilbert's, the Maroons, and many, many, many more. But these billionaires in one city change your city. That's how important it is to have a billionaire living in your city, because they can change the quality of life. Your quality of life is better because you live in a city that has multiple billionaires in it. Believe it or not, if you take away the billionaires, we don't have a basketball team. We don't have a football team. The grit that they talk about, the team that there would be the grit there. You'd be cheering for someone else's team if we didn't have billionaires who participate in that whole arena. So this Wall Street that you see here has created many of those billionaires that we take for granted. And they're talking about soon there could be the first trillionaires out there through the market capital creation. So it's just so special of a place. Now, you're looking at the center of the New York Stock Exchange. I must admit, the first surprise I had was when I walked in there and realized that it was small. It's not a big place. It's a small place that creates lots of wealth. But you're looking at one side, there's another side, there's four corners. You're looking at one corner and just expand what you're looking at, that picture, the four corners. And you see the stuff you see Spotify on that screen, you see Viking on that screen, AIG and FedEx. So these are some of the companies that turn to the Wall Street to raise capital for them. Without that capital, it wouldn't exist. So now I want to take it back. You can take the screen down now, Alice. I want to take it back to under that tree and what really happened. Ms. Geddes, we're going to have you mute your mic now that you've introduced us. Appreciate it. And I just want to make sure that you understand how capital is created. One of the biggest companies in the Detroit area and in the world is Ford Motor Company. So an example of capital creation, Ford Motor Company has borrowed, and I say borrow because in a sense, when you buy a company, you're loaning them your money, hoping that that company will improve. So let me take you back. Step one, you pick a company that you like. And in this case, I'm going to pick Amazon. So you picked Amazon and you say, I like Amazon. I like the fact that they deliver packages to my house. So I'm going to buy Amazon stock. Well, that gives Amazon money so they can buy another truck. They can buy packaging. They can do whatever they want to do with those funds. And then you order, it seems like a seamless process. You go on the computer, you order your smartphone, you press a button, and next thing you know, somebody's pulling up at your house, maybe the same night. Because they have put warehouses all around the United States to house these products. Now, people say, well, what does Amazon make? And I'm going to pause. I'm going to do Ms. Gaddis's powerful, purposeful pause. What does Amazon make? And you answered it inside your head, but I'm going to tell you, they make money. They make money. They make crazy amounts of money. That's what Amazon makes, but they don't produce or manufacture a single product because it's not worth it for them to do it. They just became the best distributor of a product out there. Before Amazon was doing it, it was a company called Walmart, who's also listed on the stock exchange. Walmart. And what did we do? We knew we could find anything we wanted at Walmart. We would get in our car, drive to Walmart, park in their parking lot, walk into the store, and they would, in every grocery store, every store is set up specifically to get your attention. The thing that everybody wants the most of is where? In the back of the store. That's the reason why the meat department's in the back of the store. Why? To get you to walk past those aisles to get to the meat department and walk back past those aisles. And why? What happens when you walk past something? You grab it off the shelf and you put it in your basket. Everything is thought out. It's not by accident that these things happen. Someone took the time to think about every aspect of what you do in life. And don't think for a minute that it's not still happening. Everything is thought out. Who's going to be the next president? Thought out. Some people thought it was going to be one person. Some people thought it was going to be another, but somebody knew exactly who was going to be it. And I'm going to call it that 2025 commission. They knew who they wanted to be it. And their guy got in and he has a playbook and he's working with that playbook. Well, how will that affect your money? Well, if he gets rid of all the immigrants that he wants to get rid of, what's going to happen to housing starts? Because most of the work on houses around the country, the construction and building, from roads to tall buildings, is being done by immigrants. So that means that building is coming to a halt in many places. How do they fast track these immigrants to get them a visa so they can work in the United States? That's what everybody has to figure out. So with that in mind, that's the challenge that Congress is faced with is, and Congress can't sit still for a minute, because the one thing we know about our current president, and it's important that I talk about him and talk about Wall Street, is that he is a busy individual. He likes having multiple things on the table at one time. We know what happened during his first administration. We now are in his second administration. So in spite of him being a busy person with lots of stuff in the air, juggling lots of balls, Wall Street made money. And they anticipate they're going to make money this time. Now, will there be some pain? Yes, there will be some pain. And that pain is going to primarily come from all these policy decisions. Now, will the policies work out better? Ultimately, yes. Let me go to one policy decision while we're talking about the president to help you understand what's going on and why is it affecting your bottom line. Tariffs. You've heard him toss out the term, I'm going to charge 25% tariffs on Mexico and China. And just today and yesterday, he dropped, I'm going to charge Europe, the EU, 25%. Because he feels like America is a country that everybody sends their products to sell, but in turn, they don't collect and treat us the same way. So everybody likes the money that we make in America to create Louis Vuitton and other products that come from Europe, but then they don't in turn buy American-made products to the level that we buy products made outside the United States. So just understand that these tariffs, and it's called the art of illusion, by the way, the art of illusion. You throw out 25%, you negotiate down to maybe 10, maybe 5. But listen, 5-10% is more than you're getting right now. And he anticipates all this money the United States is going to make off of these tariffs. And he's not going to let that go. So once that happens, you say, wait a minute, he's laying all these people off in the government, and these people have jobs. And these jobs keep the economy turning. Well, he's saying people aren't going to stop buying in the United States just because a few people get laid off. There are millions of people get laid off every year. And Americans keep on spending. Because you keep spending until that knock is on your door. And once that knock is on your door for you to be the one laid off, until you hear that knock at your door, you don't think it's coming to your house. And Trump is basically saying, we're not be coming to your house, but we're coming to a lot of houses in America. And that's the challenge with tariffs and the president, is that no stone will be unturned. So just be aware that what's going on in politics, which you watch on TV, and I got to tell you, if you watch TV all day long, there's so many news stories out and they all center around the president, you will drive yourself crazy just watching those shows. You don't know whether you're going or coming. So all I can say to you is that pull back and don't watch as much of that show. And please don't get on Facebook and let Facebook be telling you what happened in the news today. Don't let TikTok be telling you what happened in the news today. And I hope you're not getting your news from Twitter. Because if you're getting your news from Twitter, then you're getting whatever Elon Musk wants you to know. And pretty much, if he gets a chance to control TikTok, he will control a younger demographic, a younger generation, and he will be telling you what news is important. So just know it's all about control. One of the things that happens when you're picking stocks is you got to be aware of the current economic conditions that are happening in this country. That's why I started off talking about that. I set the stage for what Wall Street created so that you can understand what Wall Street is. Now, we trade at the office. We buy stocks, we buy mutual funds, we buy different aspect treasury bills, treasury bonds. We buy different things for different clients based on your risk tolerance, based on your need. And we're going to go into more of that when Alice does the Q&A. So don't forget, put your questions in the Q&A, whatever questions you have, so that we can cover those questions as we talk. And also, Make a note. I know you go to church on Sundays. Many of you make a note that on Sundays between 8:30, Ms. Gaddis comes on at 8 o'clock, but at 8:30, she interviews me. We talk for about 30 minutes and we talk about something pertaining to your wallet, something that will help you and your money. So make sure you tune in 105.9 on Sunday mornings on your way to church to catch us. If you don't tune in, your pastor may tell you, I heard Ellis Adele and Mildred Gaddis say. So either way, we got you. But just make sure you tune in because we want to make sure that you understand what's going on in this market that we're in and what happens and what you should be prepared for. And so that you don't lose your mind wondering what's going on and what's happening. We're here to try and interpret what's going on. And that's what we do every Sunday is try and interpret it and give it back to you in a way that you can take it and it makes sense. The market went way up 2 weeks ago. And the last 5 days, it went way down. It took back the gains that we had made. And that's what's going to happen. The stock market likes stability. And when the president is talking about this tariff and that tariff, talking about this policy and that policy, Doge, terms we never heard of before, but now they're becoming household terms. That creates instability in the market. That instability causes the market to fluctuate. It's a roller coaster. We had someone call the office today and said, hey, I've got $15,000. I want y'all to put it in the highest risk stock y'all have. The catch is that we don't know what if we're at the top of that market going down, or at the bottom of it going down. So we can't take the 15,000 and put it into the most riskiest stock that we have, hoping that it will go back, because every one of you know when is the best time to go shopping? When it's on sale. But guess what? It's going to be another sale next week and another sale the week after that. So which sale is the right sale? It's the end. Most of us are getting text messages now and emails saying end of winter sale, end of clearance sale for the winter stuff. So you're going to continue to see more and more sales going on. It doesn't mean that the sales are over. It just means that it's more and more sales coming. So the market's going to continue to do what the market continues to do. Now, we have some clients who've called us and said, Mr. Dill, I just can't take it. And that's fine. We're moving those clients to something more stable, less risky. There are actually stocks that the market's not affecting. The market is mainly affecting tech stocks right now. So tech stocks are taking the biggest hit, but they also make the most money. Over the last 10 years, tech stocks have outperformed any other category out there. But there's still some really good stocks out there, and we have some that we're investing in, and we're going to use those stocks for safety because they're going to keep going. They might go like this, like a rocket, but they're going to go up a little bit straight and then go up again. They're going to zigzag. So that's what you buy now. You buy stocks that are going to be more stable. What kind of stocks are those? Dividend paying stocks. Dividend paying stocks are traditionally, people buy them because they're stable. They're part of the fiber of America, and you just hang on to those stocks until what we call it, until the volatility in the market is out of the market. So the volatility is what some people can't handle. They can't handle up one day, down next day, up one day. Now, it's one thing to tell you don't look at your account every day. I had one client, and I don't see her on here tonight, but she called me and she told me how much she lost one day, and she called me and told me how much she lost. Called me next day. I said, you know what? We need to get you back working because you need a job. She said, I'm working for you, Mr. D. I'm calling you every day. I said, yeah, you are. So she does have a job. So she's helping me to watch the stock market. And that's what you all have to do. You have to make sure that you understand. So just to recap, the markets were created to raise capital. That's their purpose. Does every company that raised capital make money and exist and go to the moon like Amazon or Tesla? Any else? No. Not every stock's going to do that. Today, for the first time in history, Warren Buffett company just took their $1,700,000. They're bigger than Tesla for the first time. Tech stocks were the biggest And all of a sudden, community staples. So Warren Buffett only buys community projects, things that are staple like Costco, Apple, things that people have to have. But today, he became the owner of the biggest stock out there, which is Berkshire Hathaway, which sells for just under $800 a share, by the way. So we don't have a whole lot of Berkshire in people's accounts. It's a little too expensive, but they've had a good run. So just know that stocks were designed to raise capital. When Warren Buffett decides to buy into a company, that company usually goes up. Lately, he bought Domino's Pizza. It doesn't mean it's going to go up for you. I'm just telling you what happens when he buys into a company. I'm not telling anybody to buy any stock tonight. You got to make sure that your money works for you. All right. So, Ellis, if you would.
Yeah, would you like me to
let's
start on
put
the first question?
Do we have some that came into the chat?
Not just yet.
Okay. So, yes, start with the questions you have.
Okay. So what is the purpose of investing in stocks? And you touched on this slightly earlier.
Right. And the primary purpose is to help the company to find financing, but more importantly, is to help you to grow your personal wealth. Ms. Gaddis touched on it. Most people's biggest asset is their home. But that's not true for the metropolitan area. The biggest assets when people walk into our office is their 401k. And since they started doing pension buyouts, without a doubt, between your investment money is way bigger than what you have. If you work for 30 years to 40 years for DTE, Ford, any of the big three, you're going to get probably $1.2 million, $1.5 million as a part of your rollover bonus, your pension buyout, and your 401k. So your rollover amount is going to be $1 million. And most people don't live in $1 million house. So stocks have definitely become the new asset of choice.
And how much risk do I want to take or should I take?
When a client comes into our office, we have them take a risk tolerance. The purpose of the risk tolerance is to find out how much risk you can stand. If your account dropped by $5,000 and that keeps you up all night, you can't take much risk, especially if you've got $250,000 in your account. Now, if you've got $10,000 in your account, that would be 50% of your account. So, of course, but keep this in mind: the way we invest, you couldn't lose 50% of your account value overnight. Because even when the stock market had what we call a crash, most people lost 20%. So it's very hard for you to lose in one day 20% of it. As a matter of fact, the stock market will shut down before it lets a person lose 20% nowadays. The computers will just stop the market and everything stops when it drops that drastically. So you can't even lose that kind of money. When I started working back in the 80s, 86, we had a crash and in the market before lunch, between 9 o'clock and noon, the market lost 25%. But back then, they didn't have laws allowing them to shut the market down, so it couldn't shut it down. But since then, they put laws in place where they could stop the market from declining. So risk tolerance is something that your profile tells us how much risk you can stand, and that dictates where we can invest your money.
And what is my investment timeline?
All right. Most of us have a timeline that we want to leave our money in the market. So whether that's 5 years, 10 years, and you're investing for a reason. So let's just say your reason to invest is for your grandchild. You're trying to fulfill the Bible's promise of a legacy for your children's children. So you're investing money with, most people don't want to give children money until they're 25 and possibly 30 or 35. So when they come in, you say, hey, I have a new grandchild, Mr. Dale, I want to start investing money for them. The time horizon is, believe it or not, 20 to 25 years. So that's a longer time horizon. You walk into our office and you say, I'm 65 years old. I just retired from my job, Mr. Dale. I want to put some money in an account. One of the first questions I ask you is, okay, I wish I could ask people how long you want to live because everybody would say forever. But that's really not true. Most people get to 90 years old, look in the mirror and say, you know what, Lord, I thank you for life, but I'm good if you take me. I'm not going to go anywhere, but I'm good if you take me. So I find that many people, and I've got a client that's 106 this year, 106 years old this year, still in her, I can't say total right, man, but she's still Got a mind. So when we ask the question, how long is your horizon? We're really asking you, how long do you want this money to last? Because that determines how aggressive we invest the money, or if we don't invest it aggressively at all. But I will tell you this. If you'd walked into our office 25 years ago, when we first opened up here, and you said, you know what, Mr. Dale, I'm investing for the next 25 years, we would have probably invested your money much more aggressively than we did. But because I was working with retirees, I was more conservative. We invested moderately at best because we didn't want to take a whole lot of risk. Because I had to make sure you could retire. And that's what's important, is you being in a position to retire.
So we do have a question in the chat. So on Mildred, you spoke of the consequences of withdrawing monthly income from an annuity investment. Is this time to change if you are 73 years old?
Well, if you're 73, you have to start taking money out. It's called RMDs, required minimum distributions. The government basically says, we will let you kick the can down the road until you turn 73. Now, it is expected in this new tax law that President Trump is going to get to reset, that he's going to take that age to 75. We'll see if it happens, but if he takes it to 75, you don't have to take money out before that. But keep this in mind. You're still going to have to take money out someday, whether you take it out or whether your children take it out. What's important is determine who's in the highest tax bracket. If you're in a higher tax bracket than your kids are, and that's a great possibility because many of you on this call tonight, you made more money than your kids are going to be able to make. Even though minimum wage is higher and everything is higher, you go, what do you mean I made more money than my kids are going to be able to make? Well, the average kid has a job tolerance of less than 3 years. In other words, they're going to change jobs every 2 to 3 years. Now, in some cases, they're going to make more money, but in some cases, they're just going to change jobs. And they're not going to make more money. And they're going to change to a company that, unfortunately, is not going to be in business. So they won't have a choice but to lose their job and have to start all over again. So that's the challenge that we're faced with, is that many people won't accumulate the kind of wealth that you all built. So if you're not thinking about how can I help my children to create wealth, wealth is not going to be created. So the consequence of withdrawing money out, you basically have to pay taxes on the money that you've made by the time you hit age 73. It's called the required minimum distribution. It's usually 4% of your total balance that's in a retirement account. Now, if it's a non-retirement account, if it's a Roth, it does not apply. You don't have to take money out of those accounts. If it's non-retirement and a Roth, you can take that money out whenever you choose to. But if it's a traditional IRA account, or if it's money left behind at your employer in a 401k, you have to start taking that money out by age 73. And it's called the required minimum distributions. Now, you don't have to spend that money. You can take it out, pay the taxes, and then reinvest it. We have a lot of individuals who set up accounts that let us do just that. They have a traditional IRA. We open up a regular investment account called a TODI. And that account is just a brokerage account that we move the money from the RMD into that account. And because most people, this is what's so funny. Most 73-year-olds don't need additional income. I'm not saying everybody, but you'd be surprised how many people that between Social Security, they can pay all their bills. Because usually by the time you get to be 60, and we try and tell our clients, when you retire a lot of bills with you. In other words, don't take a lot of bills into retirement. I want you to retire your mortgage. I want you to retire your car payment. So in other words, I want you to go into retirement relaxed, knowing you can live off the money that you have coming in and not have any pressure on you to have to go work. Because what does retirement mean? It doesn't mean working a part-time job. Retirement means you're retiring. Now, you can cut back before you stop working totally. But retirement means what? Do whatever you want to do. All right.
And do you explain the investments you choose to your clients?
All right, repeat the question.
Do you explain investments to your clients?
Yes, we're happy to explain you what's in your account. We're happy to go over why we picked what we picked in your account. We're happy to share that information with you. So it's really kind of your call as to what's what. But some people don't want to know. Mr. Dale, I picked you because I want you to pick it. I want you to know. I told one client, he called me up. He said, Mr. Dale, I'm looking at my account. It's keep going down. I said, well, tell me something. Do you want to worry about it? Or you want me to worry about it? I said, because if you're going to worry about it, I'll let you do it. I'm happy to step aside and just let you have it. He said, no. You keep being worried about it. I said, then stop looking at it every day. Because in a volatile time, it's not the time to look at it. Now, it's so funny that when the stock market's going up for like 7-8 weeks straight, we don't get a single phone call. It's only when it's going down that people call us. But when it's going up, nobody calls us and Mr. Dell, attaboy, good job, sir. It's only when it's going down people call. And I don't mind taking those calls, not at all. We're here for you.
All right, so I have EE savings bonds to cash. How can I invest them?
Okay. All right. So you're going to pay a nice little tax on those bonds, but turn around and put them into something. If you bought those bonds while you're working and you still consider yourself a conservative, safe investor, then you want to take those EE bonds, cash them out, and then put them in a growth mutual fund or a bond fund, treasury bills, treasury bonds, something very safe. We'll be happy to help you out with that.
Next, so what fees or costs are involved to invest?
Okay. So most advisors, including us, many advisors are what we call fiduciaries. So that means that we have to make sure that you make money before we make money. And you see those commercials on TV saying we make money when you make money. Well, that's true. We're fiduciary. We're one of those people that commercial was designed around. So our fees are based on how much activity we need to do in your account. Now, of course, if you're a very conservative person, you want things invested in something super, super safe, those are the lowest fees possible. And then the higher fees are the things that take more effort. So if you got to watch the market more, you're buying stocks, for example, those big names we just talked about, Apple, Tesla, Amazon, those high tech stocks, those are more volatile. So that requires more activity, more watching. If you sell your Amazon stocks today, you bought them 5 years ago, you're way up in value. So sometimes people confuse selling stocks at a profit with selling stocks at a loss. So for example, you gave us $100,000 5 years ago to invest for you. We invested it in multiple stocks portfolio. And now that portfolio is worth $500,000. And the stock market corrects itself. That's what we like to say when it goes down. We say it made a correction. And you go down to $400,000. Did you make money? You gave us $100,000. It went up to $500,000. It corrected and came down to $400,000. Have you made a profit? And each of you can think about the answer to that inside your head. But the answer is yes, you made a tremendous profit. And that's what happened with NVIDIA, Amazon, Tesla, all the tech stocks. You go back 5 to 10 years, they've all tripled in value, some 3,000% in value. So they've all done phenomenal, which means you've made a profit, but you just hate giving back the profit. Now, one of the questions I get called at the office all the time, people say, well, Mr. Day, I'm looking at my account. Here's a perfect example. This is a real case, Ms. Gaddis. This really happened. Lady said, Mr. Dale, when my husband and I came to see you 10 years ago, no, it was longer than that. It was 2016, roughly 10 years ago. So 10 years ago, they came to see us 2016. She said, we gave you, our account value was $258,000. Our account value today is $150,000. So we went in, she said, looks like anybody made money but you, Mr. Liddell. I said, well, I got nothing against me making money, but that cannot be true. Let me go back and tell you how much you've taken out over the last 10 years. So we went in, put it all together for her on a spreadsheet, sent it to her, and believe it or not, she's taken out $180,000, and she still has over 150. She made money. She made good money. Because keep in mind, if you take money out, that money can't keep growing. So had she left all the money there, she'd be able to see how much more growth she has in her account. But she needed it. And what was the purpose of giving us the money? To subsidize her income. So her answer to me after we sent her the statement showing she took out 180, she said, well, I guess I have to stop buying shoes every week. So if you're buying 5 pairs of shoes, you're buying 48 pairs of shoes in a year, do you need more shoes? Or do you need to go shop in your own closet? So everybody has a reason for why they do what they do. I think the person we heard of who had the most shoes was the the president of Philippines, what was her name? What was it, Miss Gaddis? Got to unmute it.
Imelda Marcos.
That's it. Yeah. So she had lots of shoes. So this lady must have been influenced by that because she was still buying shoes every week. So, that's a lot of shoes to go through. So whatever you do, though, just know that we're trying to track the funds and make sure that you're making money. So Ellis, next question.
What are the potential returns and are they realistic?
All right. The potential returns, again, you can make, and it's really based on your risk tolerance. So you can make anywhere from 0% a negative return on your account all the way up to 100% return on your account. It's the time horizon that determines where you make money. For example, if you came to us 2 weeks ago and said, hey, I want to buy into the market, which we didn't invest the money. If you came in 2 weeks ago, we just was waiting to see how the market's going to do. We started doing 25% a couple of days ago. And you wait to drip into the market. You drip in. You don't just put it all in. You drip in based on how the market is doing. Because the last thing I want to do is you gave me money today, get your first statement, and you got less money than what you gave us to start with. So we try and make sure that the money you invest with us, that money has some growth first, because people get a knee-jerk reaction. No matter what people say, they'd rather make money than lose money all day long. Ellis?
How liquid are the investments you choose?
Okay, everything that we do is very liquid. We try not to tie your money up. Now, there's a few instances where people say, Mr. Dale, I am just afraid of the market. I'm nervous. Is there a product out there that guarantees me I will not lose my money? Yes, it's called an annuity. And the holding period on most annuities is 6 years. 6 years average holding period on annuities. We had a client come in the other day. She said, Mr. Dale, I can't lead the country like the rich people, but can you put my money in something safe until he's out of office? And I hear he wants to stay in office for 2 more years after the normal 4 years. So I said, you just described an annuity. We're going to put your money in an annuity and it'll be there for 6 years. And if you need to take money out, you can take out 10% per year without any penalties or charges. So that's an annuity. Guarantees you to, now, what did it guarantee? It guaranteed that no matter how the stock market does, on the bottom side, she can't lose more than 5%. And on the top side, it's unrestricted as to how much she can make. So that's an annuity. That's a product for people who are really scared of the market. And that's where you put it. Okay.
How diversified is my portfolio?
All right. For everybody, the portfolios are very diversified. We don't put everything, we don't bet it all on black. We spread the money out. Yeah, we spread the money out and do various investments. We will be more diversified over the course of 2025. Why? Because of the president and the fact that he's doing a lot of things. So when a lot of things are going on, the market's going to be up and down every single week. So we have to buy things that are staple. What has been making money? What has been a staple? The staples have been, believe it or not, groceries, because you got to eat no matter what. So Costco has been going up substantially. Walmart, because they have a grocery store, been going up. Target, because they have a grocery store, been going up. Speaking of Target, some people say DEI because of DEI. And Ms. Gaddis and I were having a discussion around DEI. It's kind of interesting that people would pick Target as a company that they want to start with when Ford was the first company to eliminate their DEI program. But no one's picking on Ford. Why? because they're one of the biggest Black employers in the country. So they didn't touch Ford. They figured they would touch Target. And it's interesting they would touch Target because of what Target has. I see a question here about what's the difference between stocks and ETFs. So let me tell you the story. I went to Wall Street yesterday. I had an opportunity. They called me up on Tuesday and said, "Hey, Ellis, we'd like for you to come to the Florida New York Stock Exchange." I said, "Oh, okay." So I went online, bought a ticket, and flew in that morning and went to the New York Stock Exchange. Went to an event that they had, and I met not a young man, he's not an old guy either, named Reggie Brown. And Reggie Brown is considered the godfather of ETFs. He has launched more than 3,000 ETFs for some of the biggest companies out there, and he looks like you and me. And it was pretty neat seeing Reggie Brown, big guy. He's like 6'5", like he played football. And I asked him, I said, "Reggie, did you play football? Because you meet a big guy, you know, somebody who's huge, and he's naturally huge. You think he had to play football." He said, "No, man, at 15, I knew I was going to make more than any of the football players make." And I said, "Wow." He said, "They don't make enough." So an ETF is a combination, an ETF. So think about a single stock. Think about a mutual fund, which has multiple stocks inside of it. So an ETF is a hybrid. You can have a single stock ETF, but you can have a multiple stock ETF. So a stock can be like an individual stock, ETF can be like an individual stock, but it can also be like a mutual fund. So it's kind of a hybrid, so it's in between. So he's created that. And America turned it down when he first created it, went to Europe, did them in Europe, and then America passed laws to make it possible to do it here, and he became the business benefactor of it. His company is called GTS, and we're going to put that picture back up, and you'll see GT. You won't see the S, but he has a major presence on the New York Stock Exchange. And that brother spoke to us, and he told us quite a few things about the market. And he also talked about, you know, the fact that President Trump's in and DEI. He said this. He said he's willing to bet his entire fortune. There's not a single executive in corporate America that's Black, that's not qualified. They got the job because of DEI. People don't come to him, Vanguard, American funds. They don't come to him to launch their ETF because he's Black. They come to him because he's the godfather of ETFs. He put that together. He can sit down with a company and tell them why the ETF will work and why it won't work for that particular company. And that's why they call on him. And he said, "I will guarantee you that there's not a single Black in corporate America that doesn't feel the way I feel about DEI. I'm here not because they had to hire a Black. I'm here because I was the Black that knew what I was doing." And that's going to be true for across the board. And I agree. We didn't start ELE Wealth Management because they wanted a DEI Black company in the neighborhood. No, we started it because I had worked with everybody. And out of everybody I worked with, I was just as smart as the guys I worked with. And smart is relative. How do you track smart? Sales, intellect, it's all that. Because I can be the smartest guy in the world with my shoes untied. Can't tie my shoes, but I'm a genius. Smart is relative. So if you have the ability to relate to people and take information that's complicated and make it simple, which is what Reggie Brown does every day. He takes what's complicated, makes it simple. And the guys at Vanguard and American Fund, they understood it. They're like, wow. They went before a lot of people who couldn't break it down the way he breaks it down. And that's why he's doing what he's doing. So that was probably my most unique experience is meeting Reggie Brown and understanding what happens in the whole market, capital market. But he said, man, this is the greatest thing that they ever created right here. And he didn't apologize to anybody for his house on Martha Vineyard, right on the water. He says, yeah, I make a lot of money, but I make people a lot of money. And if it weren't for some of the ETFs, many of us wouldn't be investing in some of the market things because ETFs made it a low barrier of entry for high price stocks. And that's what was the brilliance about what Reggie did. All right, Ellis.
So we have another question. As a grandparent, does it make sense to purchase stock for an infant grandchild in their name? If so, can additional stock be purchased as gifts as the child ages?
Okay, this is a great question, and it's great because of two reasons. As a grandparent, it's really best for you to put it in your name and let the child be the beneficiary. The same is true for those of you who are listening or watching. If you have a house, a lot of people like to put their kid's name on the house with them. One of the biggest mistakes that we make as a community. You want the house, you want to be able to pass and your child inherit your house because they get what we call a step up in basis. For example, you paid $35,000 for the house. It's worth $150,000 today. You die, your kid gets a $150,000 asset with no taxes on it. But if you put their name on the house, you paid $30,000 for it. They inherit a $150,000 asset that has $120,000 of profit. And now they've got to pay about 30% taxes on that house. So now they're paying $45,000 that they shouldn't have had to pay. And they wouldn't have had to pay had you done it the right way, which is leave it to them as an inheritance. That's how you pass on generational wealth. So buy the stock for your grandchildren in your name, let them be the beneficiary. We can set up an account just for you and the grandchild. So how do we do that? We will set the account up, we'll put your name on it, your social security number, and make the grandchild the beneficiary. Now, they're young. You don't want them to get the money too early. So we will ask you to set up a trust in connection with setting this money aside for your grandchild. We might not do it initially. We may do it when it gets to be real money in your account. Let's call real money. When it gets to be $10,000 to $15,000, we'll ask you to go set up a trust. Now, speaking of trust, our next seminar is going to be estate planning. Why it's important to have your assets in order. Why it's important. That's what we're going to talk about at the end of March. That's what we're going to talk about on our webinar. So make sure you tell a friend to join us at the end of March to talk about why it's important. And I'll tease it. Some people think that you only need a trust when you get close to death. No, you need a trust early in life. I got interviewed by Financial Advisors magazine, and they asked me a question. Why don't more people in the Black community have trust? And I said, because of a myth in our community. The myth is when you set up an estate plan, you're doing death planning, not life planning, not generational wealth transfer planning. You're doing death planning. You're planning for when you die. No, you're planning for the assets to be transferred. And I'll tease this part of it. When do you ask your kid or kids if they're going to take care of you in your old age? And why is that important to know? When do you ask your kid if they're going to take care of you in your old age? And why it's important for you to know whether they're going to say yes or no to that question? Because believe it or not, some of your kids will tell you, no, I'm not going to take care of you, mama or daddy. They will say, you don't have enough money for me to quit my job and look out for you, especially if they have their own children that they're taking care of. And again, we're going to talk about that. I think it's March 27th at 7 p.m. on our webinar. It's on our website. It will be on our website tomorrow. So make sure you tell your kids. And if you want to have a soft conversation with your kids, tell them to listen to the webinar. I introduce the concept, and you look at them and say, "You're going to take care of me or not?" Because they say not, then you need to be saving your money for a caregiver, saving your money for assisted living. Because nobody on this call wants to hear nursing home because of the concepts that we get when we think the term nursing home versus assisted living. So I'll set the stage for it. So just get your kids to watch. I'll take care of the rest. All right, Ellis?
All right. So do you invest in index annuities, and can you explain the difference between an annuity and an indexed annuity?
Okay, so an index is just a sexier way to create an annuity. So indexes, the 6-year annuities we're using right now are index annuities. Why? Because indexes are, you're not buying one stock, not betting on one industry. You're indexing. You're betting on the S&P 500, NASDAQ 100. You're betting on a group of stocks And in NASDAQ 100, that's exactly what it is. They put 100 stocks in a portfolio. So you're betting on 100 stocks. So it's more diverse. And yes, we do use annuities at the office, especially if someone says, I'm concerned about the market. I can't handle a lot of fluctuation. I want something that's guaranteed. That's the product we turn to. Now, mind you, guaranteed does not mean you will have no loss. Guaranteed means you have restricted loss. How much did I say the downside was earlier? 5%. You're limited to not losing no more than 5% of your portfolio. So the index annuities have some risk tied to them. The only way not to have risk, and the word annuity, is to have a fixed index or a fixed annuity. A fixed annuity is fixed. You know how much money you're going to make. It's guaranteed to pay out that, no more, no less. That's a fixed annuity.
Can I rely on historical data when choosing investments on my own?
Okay. So what we tell you here is past performance is no guarantee of future results. I repeat, past performance is no guarantee of future result. Ms. Gaddis, that's just like a guy coming to you saying what he used to do when he was 25 years old. That doesn't mean he can still do the things he used to do. Past results is no guarantee of future things. So just know the future is not guaranteed. Next question, Mr. Liddell.
So what tax implications do some of these investments have?
Okay. If you're in a traditional IRA account, you have no tax implication on the investment. So when we sell you out of a portfolio, you don't get a 1099. So if it's a traditional IRA, there's no taxes. But if it's just a traditional account, a regular account, I'm gonna call it regular, just keep the word. If it's a regular account and you sell stocks in it, we're creating a taxable event. So if we made money, it's a tax gain. If we lost money, it's a write-off. Well, how much is a write-off? Well, believe it or not, they only give you $3,000 a year that you can lose and write off per year. So with that in mind, when you have an individual account with us, we try and make sure that we limit your losses to no more than $3,000. Sometimes we can't control that, but that's our goal, is to make sure that we limit the losses because you can't write it off. So if you can't write it off, why do it?
What's your exit strategy?
Okay. All right. So for the most part, our goal is, if a client is telling us what they're trying to accomplish, our goal is to make sure that once we've accomplished that goal, we call the client and say, hey, your goal was to get this account. We've got some guys that want to get it to $1 million. What do we do when we get to $1 million? What do you think they say? When we get to them, they tell me, I want you to, Mr. Dale, I gave you $785,000. I'm not going to touch this money for the next 10 years. Get it to $1 million. What do you think they say, Ellis, when we get it to $1 million? What do you think they ask me to do then? Then they say, put it to the side and let it be safe.
Let's keep it going.
Right. They keep wanting it to grow, grow, grow. So everybody says that they're happy at $1 million, but no, they're not happy at $1 million. They want to go to $1.5 million. So they want to keep taking risks. So that's the answer to your question.
My grandchild is 3 years old. How much money should I start with in a fund so they can pay for their college?
Okay. Ideally, whatever if you really want to pay for their college, I just want to help them out. So I'm just going to say, I'm going to answer it both ways. If you really want to pay for their college, you've got to spend the same amount of money you would spend on a car note. Because the one thing about college costs is it continues to go up. I remember in 1980, when I graduated from Mississippi College, you could work during the summers, make enough money to pay tuition. Now you can work all summer long and not make enough money to pay one semester. That's the difference. So college cost is averaging $20,000 a semester. And sometimes, some places, if it's a community college, less. Now, once you get your degree, you still got to figure out how to make that degree make money. A lot of people stop studying, they stop strategizing once they get a degree. A degree is just an entry. It shows people you're willing to do the work. That's the purpose of the degree. It shows them that you're willing to do the work. But the work has to continue far beyond just getting a degree. So I repeat, if you want to save for your kids' college, put away $300 to $500 a month. If you just want to help out, put away $25 to $150 a month. Have we exhausted all the questions, Mr. Liddell?
Yeah, so there any
Okay.
additional questions, we please, ask you to put them in the chat. If you thought about it, I'm sure someone else on this call also thought about it as well.
Okay. Alice, also, if you would put the Wall Street picture back up again, and I'll talk for a few minutes about that. And if we don't get any more questions, we'll wrap up our meeting. All right. So you see a few companies listed here on the change. You've got Citadel Securities, and right there in that corner is a GTS. Elsa, you see the GTS?
In the left corner?
It looks like a GT, like global thing in the right corner.
Oh, I do
move
see
your
it right on the screen. Is it that
right, move
GT
your
right
little, there you go.
there?
That's it. Right there where you see Ellis has the hand. That's GTS. That's Reggie Brown's company. And again, one of the biggest ETF creative ETF funds in the world. And he helped set them up all over the world, Asia, everywhere. And that's his gift to the world. And he's been paid handsomely for doing so. Wall Street was created to generate wealth, and they also will take your money if you don't know what you're doing. One of the things that Mr. Brown said was computer trading kicks in around 9:30, between 9 o'clock and 9:30 in the morning. So the market's going to always be unstable between 9 and 9:30, and it kicks in again between 3 o'clock and 3:30. So I talked to Ms. Gordon, who does the trading for us, and I asked Ms. Gordon not to trade at those peak hours, during that peak time, not to trade between 9 and 9:30 and 10 o'clock, and not to trade between 3:30 and the close at 4 o'clock. Because we want to make sure that if you want to buy something and you look on the screen and you see it's priced at a certain price, that we can get you close to that price or a better execution than what you saw on the screen. So Wall Street is there to help us all to do well. All right, I see the question on there, Alice, about I saw Apple, I saw Facebook, I saw a number of individuals surrounding President Trump, and those stocks have done phenomenal. The stocks of the companies that were surrounding him. We saw Elon Musk, who I told you earlier in the program, might end up with TikTok. I can't guarantee that, but we're going to watch things that we can't buy into TikTok because it's a private company. So the person who buys that company will probably keep it private. And Elon Musk, without a doubt, has enough money to pay whatever value TikTok thinks is worth, just to be able to control things. A lot of you shop and take advantage of the delivery services. Those companies, a few years ago when COVID hit, many companies prior to COVID could not figure out how to get delivery companies to work. And now they've gotten to work, and many people have their own businesses delivering food. My warning to you, please pay into the Social Security pool. Whether you think it's going to be around or not, please pay into it. How do you pay into it, Social Security, when you're a 1099 employee? When your tax preparer does your taxes, which this is the tax season, you have to make sure that you make a profit. How do you make a profit? When you're driving your car, if it needs repairs, what if you have more expenses than you do profits? That's called a loss. If you keep doing that for over 5 years, IRS considers your business a hobby. Make sure you're making a profit. Figure out ways to make money beyond DoorDash if that's all you're doing. But the delivery companies have created a lot of jobs, a lot of opportunity. Apple, speaking of the president at the inauguration, China, Apple makes a lot of phones overseas between China and India. is a lot of where a lot of the Apple phones come from. If they put tariffs, you notice President Trump hadn't said a single word about India yet. If you put tariffs on India and China, it affects the cost of an Apple product. So Apple was represented at the inauguration. They gave money to the campaign fund. So even if they moved the inauguration on the inside, it didn't cost nearly as much as it would have cost if they'd kept it on the outside. Those companies didn't get their $1 million gifts back. It just offset the cost of the inauguration. So just know that Wall Street and those companies that were present, all those companies that were present, they expect to get a return on their investment. In other words, those CEOs didn't fly to Washington, go to the inauguration, and not have some expectation. You, in turn, should have expectations around your money and what you expect to get from and during President Trump's presidency. You should want your wealth to be more than it was when he went into office. And you should be thinking about ways for that to happen, because that's what we're thinking about at ELE. We're trying to figure out, how do we retain the wealth that you already have? How do we grow that wealth over the next 4 years? How do we set the stage for you to do well no matter what is happening on a political arena? And that's the reason why you have to help us out, by not believing what you see in Facebook. We had a client that called us one morning at 5:30 in the morning because he read a Facebook post saying the stock market was going to crash. And it did not crash the next day. That was 3 weeks ago. It did not crash. Did the stock market go down? Yes. And that's when President Trump first announced he was going to bring tariffs against Canada and Mexico. And the market made a correction because tariffs is instability. Now, I went on Ms. Gaddis' show and I just explained why President Trump said what he said and why I support what he said in that case. China's building a factory that's going to hire 30,000 Mexicans. China's building a factory in Canada that's going to hire 15,000 Canadians, and then put the factories on both sides of the United States to do what? To ship goods into America for you to consume. So he said, wait a minute, you could have put those jobs in America. Those 45,000 jobs, if you put the plants in America to make those products, then Americans would benefit from it. But because you chose not to, we're going to do what? We're going to put tariffs on them. So when those products are shipped in here, it's going to make up for it. So we're going to be able to hire more border patrol, more tariffs officials, customs officials. So we're going to make sure that we benefit from the factories you put around us. Canada came back because of what Elon Musk is doing and said that they're going to charge 100%, a 100% tariff on Teslas. So in other words, a new Tesla in 2025 that's being purchased is going to cost twice the amount that it does today in Canada. Will they stick to that? No one knows. Now, as I wrap this up, and I saw another question, so Ellis, ask me that question, and then I'll wrap up with that one. I'll answer that, and then I'll talk about what Tesla was able to pull off.
I said you are the only one that has said this. President Trump should say this.
All right, repeat the question.
It was a statement.
A statement?
Mm-hmm.
All right, let me just look at it. You are the only one that has said President Trump says this. Ooh, Ms. Funches, I don't know what you're asking me there. I'm going to give you my interpretation of what I think you're asking me there. I'm not the only one who said it. There are lots of people who say things, but President Trump has said a lot of things, and he's going to say a lot more because he loves to hear himself talk. So he's going to have a lot of things that he's going to say. What I'm saying is that your plan has to be a plan to make sure that you survive 2025 and beyond. Canada and Mexican plants, yes, not just me saying it. Those plants, thank you for that. Those plants are being built right now. And you can Google China's Mexican plants, and they're right across the border, across from the Texas border in the United States. So yeah, just Google that and you'll see the plants, and as well as the plants Canada is putting, the plants China is putting in both Canada and Mexico. The plants that they're built. So just search it out and you'll see more information on those two plants. All right, so let me wrap things up. if you hear the same thing over and over and over and over again, you hear it enough, you believe that it's true, even though it's not true. So a person great at that is President Trump. But a person even his equal is Elon Musk. Elon Musk convinced 2 million people to buy his Tesla. And he even convinced them that the Tesla was the Mercedes of cars. And Mercedes got to be the Mercedes of cars because it was quality, and it was known for its quality. So coming back from downtown Manhattan, heading out to the airport LaGuardia yesterday, I'm riding in a Tesla, and I'm thinking to myself, this is no Mercedes. It's got a really nice computer screen on it that shows you live time, all the cars coming down the highway and the people walking on the sidewalk. So you can see images of them as you ride inside your Tesla. But as far as the seats, it's not the soft leather that's in a Mercedes. And it's just not the quality of a Mercedes, but 2 million people bought it. And why? Now, whether you bought it because you want the planet to be greener and you bought into the green concept, but I remember one of my clients sitting in the office saying, Mr. Dell, my gas bill may go down if I buy an electric car, but my electric bill is going to go up. And that's what people are finding. They may not be spending $400 a month in gas if they drive a lot, but their utility bill went up several $100s per month. So it's a net gain. They didn't gain anything. Now, they're talking about the batteries and how do you get rid of those batteries? What are you going to do? What is that going to do for the planet when they end up in landfills? So then some smart people say, wait a minute, we figured out what to do with the batteries. We're just going to let them be charging stations. So we're going to send electricity to those batteries and just store it there. And we'll be able to use that electricity later. But we haven't resolved the whole issue of saving the planet because electric cars haven't saved the planet. What they're going to do is they're going to put nuclear plants back online. Microsoft just invested in, many of you remember 7 Mile Island. 7 Mile Island was a disaster here in the United States. They closed the plant because of what it did to all the people around it. And now they're getting ready to open up those nuclear plants again because of the AI need for power. AI is going to create a super need for power grids. So some small towns are going to get power grids built in their town. They're not going to build them 30 miles away from the town. They're going to build them right in the town. They may build them 5 miles away from current housing structures. And if they do like they did before, they're going to do what they did with ExxonMobil and right in Detroit, what the petroleum company did. They're going to put those plants near Black neighborhoods. So we've got a plant near Ecorse. So if that's the case, they're going to build the plants near deprived neighborhoods, and all the electricity, they don't know what it's going to do from a cancer perspective, from a sickness perspective, just having all that energy around you or near your home. So that's the reason why people tend not to want to buy houses that have those big electric things coming through the grid because of all the excess electricity. So whether Tesla solved the problem or not, the key thing is Elon Musk got 2 million people to buy into his idea. Well, believe it or not, if 2 million people paid $10,000 for that car, it would create $10 trillion of assets, 20 trillion. So they don't cost $10,000. A Tesla costs anywhere from 36,000 to 100 plus, and especially if you get the Cybertruck. So from that standpoint, believe you me, President Trump and Elon Musk are more similar than they are different. They both understand the art of illusion. That's the reason why you must stay prayed up. Yes, I said prayed up. You must continue to remember that you don't get your news and you can't trust everything you hear. You got to make sure that some of that, process it and send it back out. You can't let it keep you up at night. You can't let it worry you. And that's the reason why you have to have another way of making money beyond your own body making money. And if you're retired, you got to make sure your retirement money is still making money. Because if you're taking money out faster than we can put money in, then it's going to be hard for us to help you to stay where you are. And the challenge that you're facing is a simple one. No one tells you when to retire. That's the reason why a lot of federal workers who are being threatened to be let go, I say, don't leave until you're ready. The threat is not real until they knock on your door in your office and tell you that your job no longer exists. Then it's real, but don't volunteer to leave your job, especially if you don't have your ducks lined up in a row. So tonight's seminar, again, was about the stock market. It was about the New York Stock Exchange, which has put a lot of money into the market. I thank you all for tuning in tonight. I thank you all for telling a friend. Make sure that for next, like I said, the next seminar is on March 27th, I believe. And that seminar is about estate planning and why it's important to have an estate plan. It's not a death plan, it's a living plan. And make sure you get your kids to watch with you because I'll introduce the concept and you ask the tough question. Will you be there for mommy or daddy when it's time for us to go? And if they tell you no, believe them. Believe them and make plans to make sure you take care of yourself, that somebody's going to be there for you towards the end of your life. Because not everybody is fortunate or unfortunate enough to just die in their sleep. Many people have at least a long-term illness before they go. We're going to talk about how to prepare for all of that in our next seminar. Thank you all. Thanks, Mr. Liddell, for being the co-host. Thanks, Ms. Gaddis, for joining us, and thanks for all the questions that we got. And as Mildred like to say, we'll see you on the radio on Sunday. Take care.
Take care, everyone.